Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Thursday, October 26, 2023, and this is Blockhead Traders Weekly. In this week's episode, we are going to visit a topic called the money supply. This is a topic that perked my curiosity back when we were doing a little bit of an episode on usdebtclock.org as something I realized I didn't know a whole lot about exactly what is the money supply, how is it classified, how is it measured, what does it stand for, and then how does that feed the monetary policy and what kind of drives different monetary policy decisions, and what are those kind of levers that the Fed uses to pull. And so we're going to dive into those topics in this week's episode. But first, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, some of the other Blockhead traders, really interested in the type of content you want to hear about and the type of trades that you like to make. You can also find a link down below to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, you can pick this up wherever you get your podcasts from. And if you can't find us there, let us know and we will get it there. So let's hop to this week's content. So this week we are going to talk about the money supply, like I mentioned. And this was really driven by some scratching the surface that we did with a previous episode, usdebtclock.org. I'm going to put a link up above if you want to hop back and see that episode that kind of drove some of the curiosity here. But as far as when Viper and I were doing research into that, I was very intrigued by what this thing called a money supply is. And there was different M levels associated with it, M1, M2, and then numbers affiliated with it that were climbing or falling. And I wasn't really sure what that actually meant. I started kind of Googling around a little bit as we were kind of scratching into that episode, trying to figure out, hey, what are all the different variables, parameters, and stuff measured on that particular website? And I said, you know what, I'm going to table some of this stuff and I want to revisit this a little bit more in depth in a future episode. And so this is that episode. I've done a little bit of homework into this to educate myself on what the money supply is and then how that factors into monetary policy, which is kind of a topic of conversation these days with, a lot of the Fed interest rate hikes, the forecasting of when the Fed might pause, when they might be able to cut rates. And so this episode, we're really going to kind of dive into a lot of those topics at a high level, as this was my kind of introduction and what I've learned about it so far. So let's start by a simple question of what is the money supply? And quite simply, the money supply is the quantity of money in circulation, and the quantity of that is measured and counted by the central bank, and it is their responsibility to control the money supply, to determine how much money to let out there, how much money to bring back when they want to claw back the amount of money in circulation. And it's largely tied to interest rates, or at least the supply of money is heavily influenced by interest rates. And you can really think of interest rates as the cost of money. So what I mean by that is as interest increases, inflation increases over time, that inflation causes your particular currency to have less buying power. So you'll hear things, like back in my day, gasoline was 5 cents a gallon versus today it's, $4 a gallon, $3.50 a gallon, something like that. And that is basically the inflation over time of goods and services increasing in price relative to what the dollar or currency is that people have in their pocketbooks. And so effectively in the U.S. at least, a lot of times over time, a particular currency or the U.S. dollar has less buying power as time goes on. And that's because this thing called inflation erodes the value of that dollar away. And the dollar is actually eroded quite a bit of value. And so back in 1913 was the creation of the modern and current Federal Reserve System. And the Federal Reserve System is a bit of it, is what we're going to talk about here today, that kind of controls and measures flows of money, and it also kind of creates the lending requirements or reserve requirements of banks that say, hey, you have to keep this much money in the bank to balance out your deposits and things like that, so you don't become illiquid and stuff like that. And so there's been multiple changes to this system over the years, but it largely started and was founded in its modern day capacity around 1913. And to give you an idea of how much that has changed, is $1 in 1913. It has had roughly the purchasing power of $28 today. So if you think about it, if you had $1 back in 1913, it would be roughly the equivalent of having $28 today. And that just kind of speaks with how much over time that value of the dollar, how much purchasing power that dollar has kind of eroded away. And like I mentioned, the money supply is simply the measure of how much money or currency is out there in the world of a particular country's currency. So in the U.S., that's the U.S. dollar. Every country has its own money supply. Typically, it is controlled by the central bank of that country. And these numbers of what the circulation is out there in the various types of money are released on the fourth Tuesday of every month by the Federal Reserve in the United States. So now we kind of know what the money supply actually is, but what is the definition of money? And this is where it gets kind of interesting, is there are different levels of money definitions, starting at a 0 level and going upwards from there, with each successive level getting a broader and broader definition of what money actually is, that classify it as that. So the most narrow definition of money is known as the monetary base, or M0. You'll also hear it referred to as. So this is, and these different levels of money definition can vary country by country. So the definitions that I'm giving you here are valid for the United States. This is what the United States classifies as these particular levels. And the Federal Reserve tracks the amount of money of each of these levels, M0, M1, and M2. Now, there is an M3, I'll mention it, that does have a definition, but that is not a value that is tracked and reported on by the Federal Reserve within the United States. So M0, what is M0? Known as monetary base, it's the most narrow definition. This is your cash, your coins, your physical currency. So the money that you have in your wallet, that is considered monetary base, or M0. So in monitoring that kind of M0, this is where, when more money is printed, literally printed from printing presses or minted from coin mints, that contributes to the increase of the actual currency supply. Now, this is kind of interesting to measure, right? Because you get money that is retired. So money bills that wear out, coins that become damaged. Some banks will collect those and return those to the Federal Reserve. Those are easy to know when they're returned and destroyed. But there's a large amount of money that will basically just kind of deteriorate or get lost or thrown away or end up in a landfill somewhere. And so the accuracy of counting and out there of how much M0 currency is really an estimation. There really is no exact way to know what that value is. But the Federal Reserve does report it monthly, like I said, fourth Tuesday of every month, and I'm going to show you some of those charts here beyond that. Next level up, M1 currency. So this is basically the base currency, the M0, plus it's additive. So we're adding a new definition of things to that. And the definition would be liquid deposits into banking systems. So up until 2020, that was only checking accounts. So basically, the M1 currency up to the year 2020 included just checking accounts. So this was, by definition, the most liquid deposit that you could have. So it's a little more illiquid than cash and coins, right? But one step more from that would be checking deposits. Checking deposits don't typically have much interest rates on them because they are designed to have money pulled away, put in, pulled away, put in as fast as that can be done. They're not really intended to be long-term or longer-term savings vehicles. Now, in 2020, they started evaluating. They said, well, look, with all of these different advances of, electronic transfer of money and the way consumers were actually using bank accounts, the way they were kind of flipping around money and stuff like that, they decided that savings accounts would then become part of M1 currency or M1 money. So prior to 2020, savings accounts were not included. Then in 2020, they included just savings deposits. So this is, you go to your bank and you open up a checking account. That's M1. You go to your bank, you open up a savings account. That's M1 now. Before 2020, it was not. So now if we broaden the definition a little bit more, we go to M2. So what is M2 money? Well, M2 money is all of M1 money, which of course includes the monetary base money plus your liquid deposits. And now at M2, we're going to add what's called near M1 deposits. Okay, so still liquid, but not quite as liquid as M1. So not your checking type accounts. So this is where your savings deposits come in. This is where money market accounts come in. This is where certificates of deposit, right? These are funds that you put into a bank, but they have a fixed duration of the time that you're supposed to have them deposited. So they last a little bit longer. This is your M2 funds that's in there. Now, there is in the United States a definition of M3. Now, the Federal Reserve doesn't report on it. They don't estimate it. They don't count it. But M3 is basically your next step up. So think more illiquid, right? More further away from a sure thing, further away from quickly being able to sell and buy it. This is where your brokerage accounts come in. This is where your investment vehicles come in. Because some of those things, you got to find a buyer and seller to offload some of that stuff. Whereas, in a bank or a certificate deposit, things like that, it's backed by some sort of cash or things like that, which is much easier to trade in and out of. And so M3 is that further step away from that monetary base, getting slightly more and more and more illiquid. Within the United States, that's as far as they go with the money definitions is M3. You probably can find M3 projections, but like I said, it's not something that is regularly measured like M0, M1, and M2. The central bank tracks that very closely. So speaking of tracking that, this is where this got really kind of interesting for me, is you can go to fred.stlouisfed.org. Okay, this is run by the FRED stands for the Federal Reserve Economic Data. And there's all kinds of information posted on this website of all the different aspects that the Fed tracks, reports, monitors, all of that fun stuff. And so what I took here was actually a very interesting timeline that went from just before 1960 to present day about the current supply of M0 money supply. So how many US dollars are out there? So right now there's about approximately $5 trillion in cash and coins in circulation within the United States. And one thing that I found particularly interesting with this chart is everything started going a little bit crazy in the money supply around the financial crisis of 2008. You can see that, hey, the money supply kind of slowly increased over time, but those money printers, that physical currency generators really started to go in the financial crisis. And you get large swings. I mean, we're talking billions and billions of dollars in swings Whereas, prior to that financial crisis, yes, it was climbing up. Yes, the rate of climb started kind of increasing there around the 90s and into the early 2000s, but then everything just went ballistic there after the financial crisis. And so I found that very interesting observation. I don't really draw very many conclusions to that, other than there sure seemed to have been a lot more stability and less variability and volatility in the M0 money supply prior to that financial crisis. So this is the cash and coins. So what about, when we add in those checking deposits? What does that M1 level look like? And so here again, we see something very, very interesting in 2020. Remember, I mentioned that savings accounts were not considered part of the M1 money supply until 2020. And you can just see a stair step up there from the values prior to 2020 to after 2020. And again, you see this is not quite as volatile as the M0 supply, which I found kind of interesting, but you see some serious swings in the billions of dollars, thousands of billions of dollars of movement post that 2020 timeframe. It really started kind of, again, ticking up after the 2008 financial crisis. Now, albeit here, it's a much smoother line. And so it's more of like a slope change. But then after 2020, we get real interesting here as far as the M1 supply. Where you're going kind of way up and starting to fall back. Now, a lot of that government stimulus money, that would have come out as part of the M1 money supply. So that was likely a very large contributor from the COVID of what would have spiked the M1 supply, because that money was not coming out in cash and currency. That money was kind of coming out into checking and savings deposits as direct deposits from the Federal Reserve. And the M1 supply today is more than 3x of the M0 supply. You can see it's about $18 trillion. Well, that begs the question, what does the M2 supply look like? And so let's take a look at the M2 supply. Now, the M2 supply didn't really change definitions like the M1 supply did in 2020. So that, in my opinion, likely kind of masked some of that influx from the COVID money that was released, because that kind of all would have been lumped in with how they were reclassifying that M1 money. So part of that stair step up in 2020 when it comes to M1 money supply was a combination of some of that printing or distribution of COVID relief funds into the economy versus the actual counting of savings accounts in part of there. But when we look at M2, that did not suffer from any reclassification. And so you can see, again, financial crisis, slope change. Yes, we started slope changing in the early 90s. We changed slope again after that economic recession and financial crisis. But then if you kind of come up here in 2020, this tiny little sliver here of a knockdown, you can see likely a kind of a stair step jump up. Again, this would have been tied to a lot of those financial COVID relief funds that came out, people putting them into certificate deposits, money market, things like that, saving for a rainy day. Those would have ended up in what's classified as the M2 money supply. And this money supply is slightly higher than the M1 supply, currently around $21 trillion. So that really covers the definition of what is the money supply and the various levels of the money supply, the M0, the M1, and the M2. So what do we do with all that? What does all that actually mean? What's the follow-on from there? This is where monetary policy comes in. And so like I mentioned at the beginning, that one of the jobs of the central bank or Federal Reserve in the United States is to control that money supply. So they have to figure out, how do we control how much money is in circulation? They watch it, they report on it every month and that fourth Tuesday, but then they have to take reaction to do something about it. If there's not enough, how do they get more out there? If there's too much, how do they pull some of it back? What do they do? And that really brings us to the area of control. What type of control tools does that central bank have at their disposal to take a look and to work on this? And that's kind of the next area of exploration here, is into that monetary policy. And there are roughly 3 control points that the Federal Reserve can exercise to regulate the amount of money supply in the United States. The first of these is market operations. And this is what Viper and I have talked about in the past. This is what I do every week now when I am buying US Treasuries. And so, one of the vehicles or mechanisms that the Fed has in their toolbox to control that money supply is either the buying or selling of United States Treasuries. And whether or not they want to put more money into the economy or they want to take money out of the economy, they will do this through buying and selling of treasuries. Now, if they want to put money into the economy, that is known as an expansionary economic policy. And so they want to basically expand the money in the market. And so the way that they do that is they purchase back existing government debt. So, in previous periods, they might sell government debt, but in order to put money out there into the market, they're going to go buy that money, those debts back from whoever holds them. So as you think about it, when they buy that back from the debt holder, they're exchanging that debt and giving to that debtor the actual money, basically outflowing currency into the economy, thus the expansionary policy. Now, when they want to contract the money in the economy, they go forth and they would actually sell treasuries. This is where they're pulling back money from the market. This is a contractionary policy. And this is what's actually happening right now in the marketplace. So the Federal Reserve is kind of selling a lot of US treasuries and a lot of debt out there. And so every time that they sell one of those, they are pulling money out of the market. And so every week when I go to buy my 4-week US Treasury, if you were to go out and buy 10-year bonds, things like that, they are taking money from the market and exchanging that for a coupon to be redeemed at a later value. And so that is pulling currency out of circulation and locking it up in the form of those US Treasuries or bonds, depending on what the dated maturity actually is. So what is another tool that they have? The next tool that they have is setting the discount rate. And so what this kind of does is this is more of like a floodgate lever. So the Federal Reserve has a lending window or a discount window where banks can go to get money from the Federal Reserve. Now, that money comes at a cost to that bank. That number is controlled by the Federal Reserve with the target Fed funds rate. And so this is what you've always heard about as far as the Federal Reserve raising their interest rates by 0.25%, raising by 0.5%, raising by 0.75%. We basically just have come off of a extended period of lots of successive rate hikes. And what this does is this is the Federal Reserve saying, well, if you want to borrow money from us, you can, but it's going to cost this percentage of money. And that Fed funds rate, the more expensive they make it, the less times people will come to that lending window to take money out. And remember, every time they're taking money out, that is dispensing money into the economy, into the economic environment. So when they want to spur more money outflow, they will typically lower rates, those federal discount rates, because that will cause people to come to that Fed discount window to borrow from them because interest rates are lower. That dispenses money into the market. That also was very likely to be that spike that we went through when we were looking at the M2 and M1 supply after 2020, where we got this nice curve in the M1 supply. We also got this curve in the M2 supply. Remember, this is when that monetary policy was extremely low, and interest rates basically dropped to zero before we started hiking interest rates. And that is where a lot of lending institutions would come to that discount window to pull money out, basically flooding the economy with more and more money. So you'll hear a lot of times the people said, oh, yeah, the government just printed money and gave it to all the people as part of those COVID relief checks. In addition to that, they lowered the interest rate out there. The Federal Reserve lowered the interest rate, spurring banks and financial institutions to go take money at these lower rates to do something with. And so that was their job, because typically when you dispense money into an economy, you're doing that because you want to spur spending. You want to, and that basically drives consumption, and that consumption drives the need to produce more goods and services. If you need to produce more goods and services, that drives more jobs and job creation. And so when the economy gets too hot, you want to try to contract that money flow from there. We want to basically pull that back, make things more expensive so people buy less goods and services because they're dissuaded, because they don't buy it. And then when that happens, it causes companies to kind of scale back, and you get kind of an economic cooling effect. So this is the reasons why they might do these things. Now, the very last method that they have to control the money supply out there is known as the reserve ratio requirement. And so this is part of that Federal Reserve System of, rules that get set that say, hey, if you're going to hold X dollars of depositor funds and you're going to loan a certain percentage of those things out, you have to maintain a reserve currency in your bank. So it basically says, they can say, okay, in order for you to loan out X dollars, you have to have Y dollars kept in the bank. And adjusting that reserve requirement can cause banks to basically, if they raise the reserve ratio requirement, means you have to hold more reserves in your bank in order to do lending, in order to do financial transactions. That causes the banks to pull in money from circulation, put it into the reserve of their bank where it can't be touched. Think of it like a safety net. It basically says, hey, if everything were to break loose, it's okay. We're going to secure everything because we have this minimum depositor requirement ratio that the Federal Reserve lays down. And so they have the power to adjust that reserve ratio in the market. So it's just another lever that they have to pull. If they raise that ratio, they can pull money out of the supply by forcing banks to put that into their reserve coffers. If they wanted to let more money flow out from banks, they could dial back that reserve requirement to not require banks to hold as much of a percentage of their funds in reserve. And then the banks would naturally try to go get more profit from the funds that they hold, so they would let that money kind of flow out. And that is one of the requirements, one of the tools that the Fed can use to adjust and tweak the money supply that's out there in the market. And that brings us to the end of this week's episode. That is the content that I had prepared from my research into what is money supply, how does that relate to monetary policy, what are some of the reasons that you might want to increase the money supply, decrease the money supply, what type of tools and levers does the Fed have available to perform those actions. I thought it was actually really interesting as I kind of went through and learned about it, particularly because a lot of that stuff you see kind of going on right now in today's market, where the Fed is raising interest rates. They are trying to sell treasuries. They're trying to pull out or sop up all of this money that got sprayed into the economy during COVID, whether or not it was relief funds directly released to taxpayers, whether that was the easy monetary policy where lending was very easy to spur the economic growth, and all of that stuff during that COVID drive down really flooded the market with money to try to spur productivity, consumption, all of those things, which it very much did, to the point that, we have record inflation levels. We hit 40-year record levels of inflation. It just goes to show you that these economics actually work in practice, where, hey, if you spray the economy full of money, inflation typically follows. And when inflation rises, then the Fed tries to cool it through their tool that they have in their toolbox. And that's where we get into the Federal Reserve raising interest rates, trying to sell treasuries to claw back some of that debt. You got into quantitative tightening, which is where you have this monetary policy where they're tweaking those three different levers that I talked about to try to pull in a lot of that money that got flooded out there into the market to cool off the economy so that we don't get a runaway inflation. Because once inflation really starts to take hold, it can be very difficult to get rid of and very sticky. Because once it starts running away and you can't actually drop inflation rates because you don't have the jobs out there, or you start to get high unemployment, you can get into what people call stagflation. And that's what I think they're trying to avoid. And that's where the term soft landing comes from. A soft landing basically refers to the idea that the Federal Reserve can bring down inflation without bringing the economy into a recession, which is always a risk when you're trying to pull money out of the economy. It's like trying to take candy away from a child. And you don't want them to throw a fit. And so it's how do you get the candy away while avoiding the fit? Hopefully you found this episode somewhat interesting, somewhat enlightening. Maybe you learned something from it. As always, drop a comment in below. Let us know what type of content you want to hear about. Markets are, really taking a dive here lately. Depending on where you're looking, maybe we're getting close to a temporary bottom. Maybe this is a pause. Maybe we're in for a master drop here real soon. We'll see. Either way, there is always trading to be had, up or down. That's the beauty about trading is when done well, you really should be able to make money no matter the direction of the market. So hopefully you're finding things interesting to trade and you're doing well out there. And as always, remember, think outside the block.